So the beautiful thing about this, I'm telling you, is the communication, all the Zoom meetings, and everybody sharing an idea or a process that they think is going to help their maintain the safety of their people and preserve their community and their property.
Hmm.
I think that is the right thing to do. That is so everybody should be. I mean, job number one right now is make sure people stay safe, protect the community, and preserve the property in that order.
Absolutely. Well said, man. Hello, everyone, and welcome to another installment of the Prosperity Through Multifamily Investing podcast. I am your host, Cody Laughlin, and I have a special podcast interview for you today. With us today is my friend and also business partner, Mr. John Batey. How you doing, John?
Fantastic. Glad
Awesome,
to be
man.
here. I'm a little nervous, I'll be honest.
Nothing to be nervous about, man. This is going to be a fun conversation, and this is going to be a unique conversation because not only are we going to be hearing a lot more from John as he will be joining as the co-host on the podcast moving forward. So we're going to talk a little bit about John's background and how we got together in our business partnership, but also talk a little bit about where we're at in the state of the economy and investing now with the outbreak of the coronavirus and how that plays an impact on our business today. So, but with that, let's get started. John, tell us a little bit more about you and your background.
Fantastic. Well, thank you for having me, Cody, and I'm actually excited to join on as a host. I've never done such a thing before, but I do enjoy talking to other people, and this is how you talk to other people on a wide scale, I guess. So my name is John Batey. I currently work in the oil and gas industry. I'm an oil trader, but what I really like doing is investing in real estate, and I've been investing in real estate for the past 4 years. I've been a multifamily advocate of multifamily. So I think I've dabbled in everything. So I've done some warehousing, private money lending, single family housing, but I really like multifamily because, quite frankly, at the end of the day, you kind of have to live somewhere, and I felt like the demand was pretty good. You always need a place to live, and that's kind of where I hunkered down in the multifamily space. And I've been doing that, engaged in that for over 3 years. So it's been exciting. It's been obviously been a strong market. I think we're going to discuss that, and then we'll talk about the demand disruption that we've had lately. Yeah, that's about it. But I've been in Houston. I live in Houston, Texas. I've been here about 10 years. I've got a lovely wife and 2 little boys who are currently asleep, allegedly. So we shouldn't have any disruptions right now.
That's all right. I'm sure any of the listeners who have children definitely understand, myself included. So, well, cool, man. Well, tell me a little bit about your first introduction into multifamily. I know that, having known you for a while, you've dabbled with a bunch of different stuff. Like you said, you've been a private money lender, hard money lender, passive investor. So what was your first introduction into multifamily?
First introduction was actually through a crowdfunding site, and so full disclosure, I've been an equity investor since I was 14 years old, since I could first open up a joint account. I've been focused on equities a lot, and that's kind of what I grew up doing. I was big into value investing and fundamentals of companies and so on and so forth. And then went through the 2000 dip, and then I was in business school during the 2008 dip, and then here we are now. So we'll talk about that more. But a couple of years ago, when the first kind of crowdfunding sites came out, I was like, oh, this is really interesting. It introduced me to an alternative asset class. Because again, I just knew equity markets, I knew bonds, futures, a little bit of commodities, but nothing around real estate. Because honestly, besides buying a REIT, which I didn't think you could just really get into private direct real estate. So that was what kind of kicked off the interest. Was, okay, wow, this is really interesting. I didn't know that you could actually get fractional shares or ownership in actual properties and real locations. and have part of the interest in that operation. So it was really interesting. And so as time went by, I introduced myself to other people, other syndicators, talked to people about the business, and that's how we met. As a friend of a friend, and it's a small world, and you think there's a lot of people doing it, but there's actually not. 99% of people, here's a fun fact in my business, 99% of people I talk to don't know about joint venture partnerships in real estate or syndication, and probably have never heard of it. And I work with some high level, people with some incredible pedigrees. So it's still not super popularized. And some of that's by definition, because we'll talk about this later, as you go and raise capital, you have to have significant personal relationships that are prior existing relationships. So you have to know somebody. Mm-hmm. So networking is your net worth is very important in certainly in the real estate business, because that's kind of how the laws are structured for private direct real estate. So anyways.
Yeah, no, you're absolutely right. And just highlighting the power of networking. Most of the people that I meet in this space are somehow connected to one another through different avenues. And you're right, it's a small, tight knit community, but it's a great community. And I'm fortunate, you and I connected through, like you said, a mutual friend that I met back in, I think the summer of last year, and our relationship kind of grew from there, and here we are launching a new brand and a new business, and couldn't be more excited. So
I remember I heard you talk one time. It was on the phone, and it was a bunch of people were in the room. I think what I'm talking about. And this was on the phone conference call, and I heard Cody get on there, and he's like, he just had the passion. And like you could hear it in his voice, and he's like, "Oh yeah, I want to go do this and that." And I was like, "Okay, I think I need to talk to this guy." Here we are. So that's what attracted me to it. And by the way, I think for all the listeners out there, people in real estate are fantastic. You know why? Because they've got a positive growth mindset, and it's amazing. If you're ever in the corporate world. There's a lot of negative Nancy's out there, but by and large, folks in real estate have a positive growth, entrepreneurial mindset. And it's just a different experience dealing with, no one really views each other as competitors. They're all trying to, achieve financial freedom and be a good fiduciary and put their communities first, and all these good, positive things. It doesn't feel like anybody's trying to gun each other down like it does in the corporate world.
No, you're absolutely right, man. Everybody's here to help one another out, and we're all in the business to create that financial freedom and independence for ourselves, but at the same time, giving back and helping others do the same. It's a special bond between this community. So
I've really enjoyed all my introductions, and I love all the folks that I work with. I'm pretty blessed to have a great relationships in the corporate arena, because everybody is the folks that I work with have the utmost highest integrity and ethics. And again, that has been mirrored in my experience with the real estate. Now, there's probably a bad apple in every bushel, but so far it's been a great pleasure. So I'm excited.
Awesome. Great, man. So listen, I want to give the listeners a little bit more about your background in multifamily in particular. Again, you started with, the crowdfunding and kind of how it evolved there, because I know your background, you've passively invested in several units. You want to talk a little bit about how you came across that?
Sure. Well, again, this goes back to the network thing. Yeah, you have to know people, and then once I figured out that there are people that were raising money on a regular basis to do syndications, I said, okay, well, I guess I need to find these people somehow. And number one, you talk to people. Number two, you do a little Googling, search on the internet. I mean, the internet's a big place. And, if you have a particular market that you want exposure in or interested in, or maybe there's a Census Bureau report that comes out and you're like, wow, Boise, Idaho is really growing strong. pick up the phone, call one or two people, and I guarantee you'll have a list of 5 names before you know it that you can go talk to. And then from there, it's just kind of it's a vetting game. Okay, who are these people? Do I trust them? And then what's the deal look like?
Mm-hmm.
And all the books that I've read on private real estate investing, number one is the people, because good operators can make a bad deal okay, and bad operators can make a great deal bad, period.
Mm-hmm.
Just mismanagement, and there's a lot of, I think there are some operators that focus on volume and that quality, and certainly I want to be involved with people that focus on quality and not volume, because it is tricky a little bit when you get into private direct real estate and you have different incentive structures. Maybe somebody's got very heavy acquisition fees or disposition fees, things like that, where they get paid up on the front end. And so naturally, even though they're, quote unquote, good people, they're naturally incented to do volume versus quality.
Mm-hmm.
So it's just very important to have all these conversations up front, because folks, if you're thinking about getting into this, you can't just take $10,000 and say, okay, I want to share in this. You're looking at 25 and 50K mins to get involved, to buy a ticket, if you will, on the ride. And once you pay your ticket, you can't get off the ride. So you better really know, better trust these people. So anyway.
Absolutely. Well, and then speaking to that, in the portfolio that you've kind of created or invested in, have you invested with, one or two syndicators? Are you diversified?
I am diversified somewhat, but what's important to me is to both know the people, and obviously the deal's got to be good, and it's got to be in an area that I personally like, or somebody's got to sell me on the area and why specifically. There's this distribution warehouse that's being built right here, and it's a grocery supply, and because it's a grocery supply, it's a consumer staple, and it's not as volatile as a oil and gas pipeline distribution center that could go out of business if oil's $20 a barrel, i.e.
More on that later.
Yeah, more on that later for sure. I've people that some operators have been trained. They have certain mentors that they've had, and that brings a consistency. And so you can actually have multiple folks that have kind of been mentored the same way, that have a similar framework, and you get to trust that framework. And obviously the people have to come first, but you kind of trust that framework on, okay, well, we're only going to invest in sloped roofs, 1980s product. We're going to do agency financing, and we expect to hold this 5 years, so on and so forth. That's kind of standard protocol. And then some of the assumptions that they're making on rent gross are consistent with one another in economic vacancy, so they're not crazy. But yeah, but anyways, long story short, I've got over 1,200 doors as a limited partner and growing.
Awesome. So now you're making the leap into being an active investor, general partner. You met an awesome business partner in myself. Here we are. And but why make the transition now? Why all of a sudden, what is your?
Hey man, I'll tell you what, it's a little bit addictive. So I kind of here's what I'd recommend everybody do if you want to get involved. Now, first of all, if you don't have any time or don't have any passion about this, just be a limited investor, diversify your portfolio, get your equities, bonds, private direct real estate, etc. Do that and be a limited partner. Vet the folks that you want. Do a background check on them. Make sure they don't have any SEC judgments or huge liens against them, things like that. So that's step one. But if you want to if you're become a limited partner in a deal, and then you're like, I really like this. I think I want to start looking at underwriting my own deals, because you kind of want to bet on yourself at that point.
Mm-hmm.
You've learned, you've seen the business, you've seen how other people operate and how they communicate and how they manage their working capital on their property. And you build enough confidence that when you see deal flow coming through, and I'm just talking about deal flow from sponsors. I get, there's probably a webinar a week that I'm on and see deals through. And so then you kind of get comfortable with, okay, well, I think I can underwrite some of these, and I might want to look in certain areas for certain specific underlying economic factors and developments in that sub-market. And so now I want to see if I can do that and both invest in myself and the deals that I find, and then bring investors along for that ride, because I want to give investors a double-digit rate of return. And honestly, Cody, I feel obligated at the time to give or tell people about this as an alternative. Like I said, 99% of people, I don't know what your percentage is, but 99% of people, I feel like, do not know about this, the opportunity that you have in private direct real estate investments.
No, I think you're absolutely correct. I mean, the more people that you talk to in multiple different industries, there's just really a lack of knowledge about this space and this alternative. And as unfortunate as it may be with the circumstance that we're about to talk about, that we're going through now, this is where I think that exposure becomes so important to help people understand that, it's not, you don't have to put your life away in stocks and hope that, it'll be ready for you when you're ready to retire. So,
all right. So you're going to love this. This is going on. This is perfect timing. I literally just got a text and it says, "What's the average return on your property investments?" It's from one of my buddies that I was talking to tonight. And I won't tell you how much he lost in the stock market, but
yeah,
it will make you cry.
Yeah, a lot of people are in some bad shape right now.
I guess we'll talk about that, but on a serious note, I think people need to know about this asset class beyond a REIT, because I'm about to show you some REITs and that they've lost 40-50%, and so you have a liquidity. Everything sells off. Usually asset classes correlations go to one during extreme events, and everything falls, especially if can easily be traded. Not so with all things can fall, but a property that's run right, that's well capitalized. Every pro forma that you see, it's like, hey, it's 15% IRR, and it's very consistent. You should be getting 8% cash on cash, 10% cash on cash, and obviously it's a range, but steady distributions in something that is it's a need. You need shelter.
Yeah.
And in this economy, I mean, I think there's great macro factors to say, yep, people are going to continue to need this. Home ownership rates will not actually go up. They will actually trend down over time for reasons we can get into on another podcast. So I like the asset class. I like its prospects, and I like the stability of the returns. Especially with non-recourse fixed rate agency debt. Now, a lot of people say, "Oh, don't do fixed rate because there's big prepayment penalties and so on and so forth." But I think what we're about to talk right now is a testament to, there are some downsides for that big prepayment penalty if you want to get out sooner. But buddy, you can weather the storm with it.
Absolutely. And I want to make one point to your investing passively already, and like you said, 1,200 doors plus. You've been able to learn from multiple different operators and syndicators on how they've ran their business, how they've executed their business plan, and now you can apply that learning.
Yeah, everybody's an open book. I mean, I can send an email right now and probably get a response at least tomorrow morning from somebody, because again, if I didn't think I could communicate actively with these folks, I probably wouldn't have invested with them. So it's a two-way street. Like I said, you got to pony up $50,000 to buy a ticket, get on the ride. I expect some customer service. So anyways, yeah.
I would sure hope so. But I just hope that the listeners out there understand that, it's okay to start passively investing while you're learning this process of being an active investor and whatnot. And so, and especially
real quick,
sir,
I'd like to give a tip if anybody's out there looking at passive investors looking for a syndicator, or somebody's, they know somebody's going to bring them a deal or something. Do a background check. It's pretty cheap. Jeremy Roll, who is he's a very popular limited partner. I think he's got over like 70 deals under his belt, actually active.
Wow.
It's something crazy. Anyways, but when you listen to him, he's like, hey, listen, you need to vet these people, do a background check. So I've heard a story or two about, some people having some SEC pending investigations or something. So you just want to stay away from that.
Sure. No, that's a great point. There's a lot of people out there in the space trying to get started, and you want to just make sure you're vetting and make sure that you're,
just do diligence and pay your $35. Just make sure they're not, scamming people. I think that's probably my, look at a deal. Deals might look good, but you just got to check the folks out. So
absolutely. Well, cool, John. Well, listen, I want to segue into kind of the state of the market we're in right now. And for the listeners, at the time of this recording, we are at the onset of the coronavirus pandemic. And we are just now getting, I believe, maybe the second week into social distancing and whatnot. And so I really wanted to talk with you about what we're seeing in the equities market, what we're seeing in the economy in general, because I know that you have a very good finger on that pulse and you have a lot of knowledge to share. And so I kind of want to segue into the rest of the conversation to that, because I think it's important that by the time this episode will air, we're still going to be definitely in the heat of this onset. So for everybody, I mean, it's March 21st. Right now, I think there's 300,000 cases worldwide. Yeah.
The U.S. is probably number 4 in the world. It's like China, Italy, Spain, maybe Germany, USA, as far as absolute number of cases. And it's growing quickly.
Yeah. It's been pretty alarming. I mean, just to think of what, maybe not even a month ago, we were riding this high and life was looking good, and now all of a sudden
everybody's forecast for 2020 was like, oh, it's great, it's gonna be fantastic. And then this hits you out of nowhere, right?
Absolutely. Yeah, it's definitely unprecedented. So again, with that, I want to talk a little bit about let's start off with what we're seeing in the stock market, the equities market, and I know that you have a good understanding of that. So tell us a little bit about what is actually taking place in the stock market. What are we seeing as of today?
I think you can turn on Fox News or CNN or whatever channel you want to right now and get the picture. But it's a kind of an unprecedented global response as far as governments acting to slow the spread of a virus. And if you don't have people going out every day doing their shopping, or their kids are not in school, you can't travel anywhere, you can't go to the restaurant, economic activity slows down significantly. And this is happening all at once. And remember, the reason it's unprecedented, it's not the mortality rate, it's the response by governments. And so the Spanish flu killed like millions of people. Okay, we're not going to have this type of human death toll. Praise be to God. But the government response to this has been fairly strong overall globally. Now you can argue if somebody's fast or not fast, and okay, that's fine. Mm-hmm. But because of our integrated global supply chains and just-in-time inventory, when something shuts down, the other part of the world feels it. And particularly when the U.S. economy shuts down, or I'm not saying we're down, but activity is extremely low.
Yeah.
Just because you're not going in the restaurant, the cashiers aren't working, hotels are laying off people, things like that.
Absolutely.
So when that happens, it's first a demand shock, and it's also a supply chain shock. So you kind of get a double whammy. And for us in Houston, there's a secondary issue where we're having a little oil price war again, like in 2014, starting in 2014 with who has the most market share for oil production. That's a separate one, but a double whammy, if you will.
Sure. And again, I just want the listeners to understand that the reason why we're going to spend some time talking about this today is because this is going to be a event that definitely will impact us as real estate investors. This is definitely going to have an impact on the real estate market. And if you've heard or been in the space long enough, you've heard that multifamily, one of the reasons that people are attracted to multifamily is that it tends to be recession resistant. But this circumstance is going to be quite different. And so, we definitely have to understand the dynamics that are impacting our investing businesses in multifamily real estate. So, but going back to, your point, you mentioned that you're in oil and gas. What are some of the things that you're seeing? You mentioned, price wars going on. How do you see that impacting?
So I guess it's pretty simple. People aren't driving as much. So globally, people are cutting refinery runs, which decreases the amount of gasoline make. Jets aren't flying anywhere. Jet fuel has been unprecedentedly crushed. It's really impressive, actually. It's sad, but people are out there buying ships right now to put jet in to just float it. A ship could cost like $40,000 a day.
Wow.
And it's totally worth it because they're like, how low can jet get? At a certain point, we gotta make it and float it.
Wow.
Anyways, but that's just one piece of the economy, and but we're seeing this everywhere. So it's not just this industry, but it's that industry. It's the automotive manufacturers. Okay, so those guys have got to shut down because they can't get parts from this other part of the world, and then that plant has to shut down that makes this specific widget for them, and it's just a cascading effect. So it really hurts a lot of people. People that are in skilled trades like welding or plumbing, electricians, all their work is being deferred. So like, you know what, we're not going to do that maintenance or that huge capital project that we need 1,000 people on. So we're going to back up on that. And then at the same time, you've got obviously the service level businesses, consumer service of restaurants and hotels and leisure services backing off. So overall, it's an unprecedented slowdown that basically took place over 2 weeks.
Yeah. I mean, what was in the past?
It's really the speed that's amazing.
Sure. What was in the past 2 weeks? I think $1.3 trillion worth of wealth was wiped out.
Yeah, and listen, equity markets go up and down. Okay, so I'm going to make this plug right now. Diversification is the only free lunch. All right, be diversified. And I am definitely an active trader. Okay, in the equity market. Other people are purely passive, but I like to have some indicators that I'm looking at to say, okay, well, I need to pare down my exposure in this asset class and maybe move to cash or some other asset class. Mm-hmm. But and I'll show you some of the things that I'm looking at for that as well.
Yeah, well, that was going to be one of my next questions for you is, somebody like myself who's not invested in the equities market, what are some sites or what are some resources out there that we can
You look
look
like a
at?
genius, by the way, if you're not invested in the equity.
Well, I'm sure people about a month ago were arguing the differ,
Yeah, they're absolutely. Yeah, they absolutely.
So
And again, it's about controlling your risk. Okay, when you're in this business long enough, it's about controlling risk, and diversification is good risk control, and like some very high level macro systems to know when to hold them and know when to fold them. Quite
absolutely.
frankly, and I'll get into that. I don't know if you want to talk about that now. Or
Yeah. Just really want to segue. I know we were having a conversation earlier today, and you had some great resources on some things that you use to kind of monitor, some of the day-to-day progress or things that are going on in the market. So can you talk a little bit about those resources that?
Yeah, sure. I think the first one and my primary point is going to be credit. Okay, so credit. When the credit market gets spooked. Okay, so actually we can just go back in the headlines and check this out. So Boeing, for instance, I believe in the past week that all this happened, and Boeing's like, hey, I need to get bailed out. And that, don't get me started on that one, but that's a whole nother can of worms that I'll get into. But they said, I need to get bailed out, and they immediately drew down their $13 billion line of credit. And every other company that I've known, you can just Google credit lines in Google and hit the news feed, and you'll just get a list of everyone that's tried to issue debt and get some cash, or that have drawn down their credit facilities. And when that happens, everybody gets spooked, credit markets get spooked, and that's why the Fed and all the other central governments try to come in and backstop some of these operations, because you're talking about trillions of dollars, and they're trying to keep that money flowing, because what keeps the economy flowing is an easy transference of money between institutions and payments, and we'll get into that in a bit. So credit markets are the first to give the canary in the coal mine. Oh yeah, is this no big deal, or is this okay? You need batten down the hatches type scenario. Mm-hmm. And so I'll share my screen with you real quick. And this is a free tool. I think everybody can use it, and it's posted by the Federal Reserve. All right, so it's up there. It's up there every day. So I'm gonna share my screen real quick, Cody. And I'm going to go to the Fred site, if I can find it. Actually, you know what? I'm going to go to Koifin. All right, I'm at koifin.com because I think it's a cool little nifty site. Koifin.com/corp. Corp stands for corporate debt. And when you get there, you'll see total performance. I click on something called option adjusted spreads, and we're just going to take a look at some B grade bonds. I'm going to unclick all this other stuff just so we're clear. Okay, and now I'm going to look at 20 years of data. All right, so you see that big pink line up there, Cody?
Mm-hmm. Yep.
All right, that is 2008. That's peak kind of credit spread. So what that basically means was any basically BBB credit grade debt was trading at 2,000 basis points above. I think this is referenced off the 10-year Treasury. The 10-year Treasury, by the way, is like 1% right now. Maybe it's like 0.9 or 1%, something like that. So extremely low.
It's crazy.
But this is basically just differentials off of 10-year notes. We see the spike in 2000. We see the spike in 2008. We see the other spike basically in February of 2016. This is when crude got mashed down to like $28 or $25 a barrel, WTI. And it bounced back. What I really want to point out is you see how, this thing went up like a rocket ship. You can barely see the slope. It's just a straight line. That's been the past effectively 2 weeks. So the velocity in which it launched was extremely strong, and it hasn't even pegged down. So it hasn't It hasn't done one of these. It hasn't hooked.
Mm-hmm.
So just by casual inspection here, I'm not doing anything rocket science. The peak here for the credit market for corporate, let's see, when's that? November. Okay, looks like November, December 2008. Now, when did the equity market bottom? Do you remember? You remember the date?
I don't know.
It was March 9th of 2009. And so everybody thought we had a bottom because credit hooked over. And then it was 2 months later after that, the equity market bottom. So what I'm really trying to say is, until this thing hooks over, you got no chance. If this thing is still going up, and even if somebody's like, oh, we're going to catch the bottom in the equity market, I wouldn't believe them. Don't put all your money in that basket and try to run it way back up. So just be careful. So credit markets usually bottom before equity markets. And so just keep an eye on it. I'm not saying it's the end of the world, but keep an eye on the credit market. So you can go here, check it every day. Just stay up to date on it. But again, it's called the option adjusted spread. If you don't want to go here, you trust the government site. Bank of America publishes a high yield effective index yield. But basically, you can read the details below, but it's basically doing the same thing. It's got the same history. So you can check it out. But that's my recommendation. Keep a strong eye on the credit market, and then things usually follow that. Now, why is that important in the credit market? I said credits usually gets better, then equity markets usually get better, and then ultimately jobs come back. I said ultimately. Okay, let's scoot into that. Actually, any questions first on the credit thing? Before
No, man, this is great. Keep going. Keep going.
I'm going to stop sharing just real quick. So secondly, what happens after that? So we've got this demand destruction. We've got global supply chains interrupted. What do we do? Hunker down, wash your hands, kiss your family. Actually, I'm the positive thing out of this thing. I was like, well, this will help strengthen families. Like everybody's got to come home and hunker down together and persevere through this challenge. And I think that's positive for families in the U.S.
I agree.
And globally. So that's my silver lining.
I would agree with you.
But for practical purposes, jobs will be lost in this, and you're going to see unemployment claims come out this next week, and they're going to be hot. They're going to be
sure. I mean, what was the number we saw earlier today? We something like, I forget how many.
Well, I want to share my screen now again. This is another site that I go to. This is advisorperspectives.com, and they basically track all the Bureau of Labor Statistics updates. But look at this blip up, most recent 12 months. So this is unemployment insurance claims on a weekly basis. You see that tick up, that little red dot right there?
Yeah, wow.
That's a big move. And that was last week before everything really started getting hammered down. So we're going to see this tick up significantly. And there's going to be people, I mean, there are people laid off. So actually my brother-in-law, his company basically furloughed all their employees. And I had to ask what a furlough was. And that means you don't get paid.
Yeah.
Even if you're salaried. Hourly or salary. It's basically like being laid off, except I don't know. I honestly.
Yeah, I was talking to my younger brother earlier today who works in retail, and he actually got furloughed himself, and so.
Yeah, it's an awful thing.
And so for those who are just listening on the podcast and not able to pull this up on YouTube, we're looking at this unemployment claims graph on Advisor Perspectives, and right now what we're seeing is as of the past 12 months, well, in the month of March, the past 2 weeks, we're seeing unemployment claims jump up almost about Was that 50,000, John?
It looks like 70,000 week
Yeah,
to week, which it's been plus or minus 10,000, and now it's bumped up probably 70,000 above that.
absolutely.
And
So
that's the first data point, but we expect, and all the other economists are expect to do it. And by the way, I'm gonna put my disclaimer in here. I am not I'm not recommending buys or sells of anything. Do your own research, consult your financial advisor. I am not a financial advisor. So there you have it.
yes, thank you for putting that in there. That's
I have to have the disclaimer.
this is purely just subjective.
Yes, absolutely. So I am not your financial advisor. Talk to your CPA, talk to your attorney, talk to your priest.
Well, let's kind of sum all this up, John. And we talked about, the cascade in the economy slowdown and the impact we're having on jobs. So I want to kind of bring it back full circle. How is that going to impact us at the multifamily level?
So we know that a wave of jobs is coming, and actually Goldman Sachs I think this was a couple of days ago, they said Q2 GDP is going to contract by 24%. I mean, they were saying like 10%, now they're saying 20-something%. There's a lot of different estimates out there, but it's basically double-digit contraction. So we're going to have a little bit of shrinkage in Q1 and Q2, and a big shrinkage in Q2. So long story short, what does that mean? It means a lot of people that work especially in the retail services. Actually, I want to show this chart because I think it's very helpful to visualize the amount of people that are impacted by this.
Mm-hmm.
If you can't get together socially, hotels, leisure, nurses, I mean, you know this, dental hygienists, first line supervisors for food preparation, teachers, a large part of the economy is impacted by this. So I'm going to show this one last graph just to get this apart. And I think this is from the Wall Street Journal. If you can't get close to people, and this is just a bubble graph of the population of the U.S. employees and their various tranches of pay, so $50,000 or more, $30,000 to $50,000, and then $20,000 to $30,000. But look at all the people on this very close social spacing list and their relative incomes. The reason this is important is because when you think C and B class apartments, these are the first people that are impacted,
Mm-hmm.
right? And those are your cash flow tenants. Your cash flow tenants basically are always kind of your working class, and so they need those paychecks, and maybe they can go a month, but they really usually need that continued cash flow. So right now, the folks that I've talked to March collections seem okay, but everybody's hunkering down for April and May, especially as there's been talk about forbearance for single family mortgages.
Mm-hmm.
And people have taken that to say, oh, well, my rent's not due. And folks, I mean, and to be frank, I think some operators are offering like, hey, pay half your rent and we'll catch it up back in the next 6 months. And I think that's a responsible operation given this unprecedented time. But your delinquencies are going to go up.
Mm-hmm.
And even if people have the ability to pay, they could not. So you're going to see delinquencies kick up. Your net rental income that you expect to make. I mean, I've heard some people talk about 20 or 30% less net income coming in for April and May. Mm-hmm. Now, the question is what happens after April and May? So I think we've all gotten our head, okay, let's batten down the hatches. Let's not do those unit renovations right now. Let's do virtual tours. Let's get as much online presence as we can versus relying on that foot traffic to get these units filled up. Even if we have to fill the units up at a discounted price, certainly for the next 2 months, it's probably worth it versus having that vacant unit because some folks' foot traffic has cut 10 times less. I mean, just divide it by whatever foot traffic they're getting, divide by 10.
Sure.
So
I think that you're going to see who really are the savvy operators coming out of this, right? Who did a great job of being conservative in their underwritings. I think we've seen a lot of bullish and aggressive acquisitions over the past couple of years, just riding this market high, right? And so now with this just really unprecedented impact that we're going to feel over the next several months, you're going to be able to see which one of those operators have really had the experience, if you will, to manage this storm. So.
Sure. Who had enough working capital?
Mm-hmm.
Whose bank account is big enough right now, and they planned on it. So some people plan on not having a lot of working capital, or maybe they just don't think about it. By the way, limited partners, you want to be a limited partner. That's the question you should be asking right now to other folks that have deals coming down the pipeline. How much working capital are you putting aside? Are you putting the first year of insurance aside in the rainy day fund? How big is your rainy day fund per unit? So ask that question. It's important, and this bears it out.
Yeah, absolutely right. Absolutely right. So, what's our strategy moving forward? We've been observing and we've been seeing what's been impacted. With already, again, we're very early on in this crisis.
First of all, we have not seen any kind of pain right now yet.
I agree.
People can see it coming, but it hasn't really gotten solidified in people's minds. And we're going to see worse headlines regarding this virus in the next 4 weeks.
Mm-hmm.
And there will be more impacts in people's jobs. So we haven't seen the worst of it yet, in my estimate.
Yeah, I would agree with you. I think the effects of this are going to start showing light in the next couple of months down the road. And that's where things are going to get really even more challenging, right? So Again, moving forward, what's our strategy, or what's the strategy? What should people that are maybe just now getting into the space be considering in investing, in particularly in the multifamily space?
What should they be looking for as an LP?
Well, I guess for an active investor, those who are looking to syndicate.
Yeah. So honestly, I don't think anything's going to get done for the next 2 or 8 weeks. Okay. So spend this time talking to your investors, saying, hey, educate them about the situation, what you're looking at, or what you potentially want to look at, and start doing your homework now. Because honestly, the activity, I think the broker activity is pretty much going to slow down pretty hard. It's a good time to talk to loan officers. It's a good time right now to engage lenders on what's coming down the pike. Hey, what's the situation with forbearance? Fannie and Freddie are allegedly rumored to talk about this in next week. So for any of those operators out there that haven't cut distributions and want to get a little bit of forbearance on their payments, you probably want to consider cutting your distributions, because if they see you, flinging money out the door to your investors right during this time, they might not want to forbear their obligation.
Sure. Well, and from an operator side to that point too, if you are being granted forbearance, you want to make sure that you probably don't want to be paying out distributions to limited partners either, as well. You probably want to preserve that capital, A, to make sure you weather that storm, but B, if you're able to undergo forbearance and then I had a point to that and I lost it. I'm sorry. Okay. Anyway, continue.
Well, talk to your lender if you've got one. It's a big deal. Every situation's unique.
Sure.
But yeah, so let's see, what else do we want to look at? We want to look at, just continue working your market. Pick the phone up and call the brokers. It's not like there's going to be deals, but it's not like you can't not talk to somebody. We talked to a broker yesterday.
Mm-hmm.
Had a quick conference call, kind of explained the situation on where we're at, and they appreciate the two-way street, to be fully transparent, and based on you just got to tell people where you're at. And closing a deal right now, I would strongly recommend you probably renegotiate that at this time, because again, this is kind of unprecedented. So this is not one of those, oh, no big deal, nothing's going to happen, because you're going to be coming into a deal that has some absolutely terrible NOI growth, or excuse me, shrinkage. Not even growth. It's not even slow growth. It's shrinkage, and coming into a hard period. And you think April and May is hard, you'll probably find June and July are hard too.
Absolutely. Yeah, absolutely. Yeah, again, I think, anybody that's just getting started right now, I think we've been long overdue for a market reset. And I definitely think that this is going to have an impact on that. But you definitely want to be very cautious and very astute to the impact of what is potentially going to be occurring over the next 6 months, 12 months, and probably even longer.
And every statement that you get for the next, honestly, 12 months are going to be a little squirrely. You're going to have 2 months worth of like max pain in that T12 and that T3. So it's just, again, and you talk about the market kind of being overheated or whatnot, and yeah, that was true, but people were bidding it up, and a lot of the operators I talked to, they're like, yeah, we couldn't find a deal, and I was like, great, I'm glad you couldn't find a deal, because that means your underwriting was too conservative. I'm got air quotes for all those on the podcast. They're too conservative. That means they were doing the right thing.
Yeah.
If somebody had a bunch of deals in 2019 and 2020, I don't know. They were underwriting pretty loose, possibly. If they did like 6 deals, maybe they're a really big outfit. But I'd be surprised if you're a small operator, under 1,000 doors and had that many deals and were really doing conservative underwriting.
Yeah, you're right. And again, I think just it's going to be interesting to see how this unfolds over the next several months, and which operators are able to weather this storm.
Yep.
So.
No, it'll be telling. But again, you got to look at the outlook for multifamily is pretty good. We definitely have low rates right now. I expect prices to ease off the highs. All businesses are based off their cash flow, and we think cash flow is going to come down, and so therefore these valuations have to come down.
Absolutely.
Yeah. So,
well, and we were just watching a webinar earlier this week from the great Neil Bawa, and he mentioned it as well, that we should be holding out for the next 6 to 8 weeks.
Well, he's like, don't do anything in the next 6 to 8 weeks for sure.
Absolutely, but not because out of fear. There was going to be deals that come out of this, but we haven't even seen close to the bottom yet. And so part of that is
you won't know April's collections until May 1st, and you won't know.
Yep.
You won't know May until June. So yeah, of course, you got to wait till those. We know those are going to be bad months, and then we are optimistic that there's a recovery after that. Mm-hmm. But we don't know what that'll bring. And I'll make one point, Cody. Market Houston. Okay, we talked about the double whammy. Houston's going to have some issues. I mean, I look at all the corporate earnings right now, and not the earnings, the warnings, the corporate warnings of, hey, we're going to cut CapEx for 2020 and 2021. There's a lot of capital not being spent in this area and in Texas and all the above. And so that's going to impact a lot of folks here as people hunker down to fight another price war, oil price war.
Yeah, absolutely.
So that's just so we've got oil price war in our hometown, if you will, and demand shock. So know your markets, folks. I mean, God forbid you're in Odessa, Midland right now, and I'm serious. I mean, that's going to be that's going to be ground center number one as far as issues in certainly in valuation. So if you bought in Midland, Odessa, I mean, really, I really hope you do well, and you just need to hunker down.
Absolutely. Yeah. Yeah. And for those who are listening, any of these, experience indicators, we definitely are in hopes that you were able to weather this storm. We are definitely hoping that everybody comes out of this.
Nobody wants anybody to go out of business or lose anybody.
Absolutely.
At all.
Absolutely.
But I would, if you're not taking this serious, please shift gears and take it down in the first gear. If you're renovating units right now, I would probably stop spending that capital. I'm not making distributions. Be responsible with your common areas. I mean, you got to fight the virus first, okay? So you need to stop activity in there. Try to be good to your staff. Try to keep them employed. I mean, but I understand the pains that will come to it. So at least consider half hours or something like that to keep some semblance of normalcy. Don't do any only as needed repairs, and I'm talking like air conditioner breaks down, your heater breaks down. Okay, repair that. That's fine, but keep things to a minimum while you try to go through this. And then I'll also say on the offensive to try to get these places leased up. If you don't have an online presence and people can't find you online, you are at a severe disadvantage. And I would strongly suggest you use any of that, maintenance money that you're not spending right now and get somebody to help you out in that digital front, or start posting on Craigslist or Facebook.
No.
At least that. Those are two free sources that you can use. But you need to get out there and start competing in that online space, because I'll give you an example. Restaurant shut down up here in North Houston, and the reason they shut down was they didn't have online presence, and they didn't the space was physically like too small to have people in there, right, for social distancing.
Mm-hmm.
So they're like, yeah, we just had to send everybody home, and that's because they didn't prepare a secondary means of people contacting and doing business through to-go orders. So,
right.
Yep.
Well, John, we're getting near the end of our time here, man. And I think, unfortunately, with just the state that we're in, we're going to be having these conversations for the next several weeks to come.
Yeah,
so
I'm monitoring the situation day by day, and it's nice talking to other people and the learnings that have been shared. And I'm just talking about the commercial real estate folks have been good. So everybody seems to